Happy Friday, y'all. This is Darius Dale here to present our macro minute for Friday, November 5th, 2021. Starting with markets, we got stocks mixed with U.S. equities leading, Asia lagging. You have commodities and crypto mixed as well. You have the dollar up, global bond yields down. Big mover in terms of the leading to the downside. China down a full percent today. It's been a massive laggard month over month. You have the Shanghai Composite down 2% versus up 9% for the S&P 500, up 14% for the Nasdaq. I mean, just taking it to the chart here, I do remember a chubby black guy saying, "Hey, don't buy the dip in China yet. It's not cheap enough yet because we're heading into the sharpest part of the slowdown, the deepest part of the slowdown." That's an issue because not only is China decelerating, as our data continues to show, these are our nowcasts and our projections, as our data continues to show, China is also decelerating while the rest of the world is accelerating. So clearly, there's no fundamental support on a relative or absolute basis to be long China risk here on the equity or credit side. We do believe that opportunity will present itself in the early part of next year, but this is not the early part of next year. It's Friday, November 5th. On the economic front, productivity that actually decelerated, U.S. productivity growth decelerated minus 0.5% year over year. That's actually the lowest number we've seen since Q4 of 1993. Some of y'all weren't even born in 1993. Unit labor costs accelerated to 4.8% year over year. That's the highest number we've seen in a few quarters. The market and the companies themselves are actually starting to get some news. You heard that Qualcomm guidance that the market and the companies are telling you to bet on a temporary reprieve of some of that margin compression that we've seen in Q3 and that we've seen throughout the Delta variant phase. And this is something we've been presaging, obviously being raging bulls on stocks really for a while now. In terms of what's overbought and oversold, Nasdaq's overbought, dollars overbought versus the Canadian loonie. Oversold, you got Russell volatility, WTI, Aussie dollar, British pound, 10-year boon, 10-year gilt yield, 10-year Swissy yield, 10-year JGB yield, and 10-year Treasury yield. So clearly you're having a very big Goldilocks type effect in markets. We'll see if that holds. Obviously, they're all oversold. Looking at the risk reward setup today, you got 3% downside in the S&P 500 versus 0.1% upside. This thing has been just hugging the upper boundary of its probable range. It's called bears are trapped. The market won't let them in. WTI's at 0% downside versus 13.5% upside by the dip there. Bloomberg Dollar Index 1.1% downside versus 0.6% upside. And then lastly, 10-year Treasury yield again at the lower boundary of its probable range with 27 basis points upside. We're not going to get that 27 basis points. In fact, we may get the hugging of the lower boundary, the probable range for all these 10-year bond yields may actually be a leading indicator of the return of Goldilocks. And if that happens in Q4, I swear to God, you bears better cover shorts before that happens. So with that, Darius Dale presenting our macro minute for Friday, November 5th, 2021. I know it went a little long this morning, but there's a lot to throw at you. If you like what you see, come check us out over at 42macro.com. Appreciate you.